Welcome to our mid-year update. We would like to share with you some very important points so that we can look at what's ahead. So today it's an investor update with some ideas and strategies at the end of our short little presentation. Virgil said the greatest wealth is health. Absolutely true. So what we would like to encourage all to do is to stay safe and to try and be positive. It's very unusual times we're living in, and people are seeing that there's a lot of pressures from this particular situation. But these challenging and unprecedented times can be met and can be overcome. I want to review the 5 areas that financial planning entails: preservation planning, retirement planning, tax planning, estate planning, and investment planning. Today, we're focusing on investment planning because it's about the equity markets and how they're doing. But we want to point out that we are a comprehensive wealth management firm. So we look at all of these 5 areas whenever we make recommendations. So this is a good example of what Charles Dickens said: best of times, worst of times. The year has been a real roller coaster, hasn't it? This is a graph of the S&P 500 through July 2. And you can see from the graph that in February, we were at an all-time high, and the market just cratered down 34% because of the impact of the coronavirus reports and what was going on worldwide. This deadly virus has decimated our 11-year bull market, and it took less than 3 weeks. So we went from a high to an all-time annual low in the same period of time. It shows how things can happen quickly, but if an investor did not panic, you were very close to where you initially started by the market close on July 2. So long-term investing does work. Here's a few of the reviews from the second quarter. So the Dow's up 17, the S&P's up 20, and the NASDAQ is up 30. This shows you how much of a rebound we have seen in the markets. And these type of things that we're talking about here isn't to encourage panic, but rather to hold your positions and do the best you can. Here's some of the things you faced. Bond yields were ultra low, and that affects CDs if you're investing in CDs. Gold was at an 8-year high, so if you're looking to buy gold, it's a bad time because of the high. Unemployment was up, and we have gone to the highest level since the Depression, though June and May's report both have improved, and we'll see how July looks. Oil has rebounded. Remember the negative days, and now we're back up to about 42 as of today. And Chinese factory activity is rising, and some are concerned we'll lose control of the corona outbreak. We want to spend a few minutes here because at the June session of the Fed meeting, Chairman Powell said that the pace of the recovery is dependent on the path of the coronavirus. You'll note there on the right-hand side how the interest rates have just gone to 0. The central bank has committed to doing whatever it takes to maintain the confidence in the economy and to try and bring back maximum employment and continue with price stability. So far, so good. We are seeing improvement in unemployment, and we're also seeing that the prices are fairly stable. We are specifically, Chairman Powell said, we're not talking about raising rates, we're thinking about providing support. And they said that we anticipate to see some more shrinkage in 2020, but they also say that we would see gains by the end of the year. So that's in the economy overall. Their interest rates have been lower to zero. This is the second time in history, 2008, and then 2000, or I should say 2020. So this gives us how Fed fund rates were, and this also shows us how expensive it is to seek quote unquote safety, because these lack of um, fixed rates being available, putting your money into a quote unquote safe investment gives you nearly zero return. Therefore, equity should be part of your review. So we're bringing this out here. Though the equity markets are not the economy, you can see from this that the stock market does give us a good gauge. It is predicting that the markets are predicting we will see stabilization in the overall economy. So let's look at how this is happening. We see the overall view of long term, but let's see what we could expect. So there's three models of recovery. The V model on the left is where we see the sharp decline and a quick rebound. Some are predicting a W recovery, which is also called a double dip. So you see it goes down, comes up, and then goes back down again. And then we see the L-shaped recovery, which is typically down and then a little bit lateral in its growth. So what one will we have, or will it be a combination thereof? We don't really know that answer. The future is hard to tell. But the rate of improvement in the markets is being forecast by most people. The underlying issue is the coronavirus and, of course, the unemployment rate. Are we going to be able to live through it? Absolutely. Will there be injury? Yes, there already is. Will we see a vaccine? We certainly hope so. Now, this is another chart to give us a little backdrop here. We see a huge run-up in the market from 2010, where it dropped, actually 2009, to where it dropped to 2020. So it's a great 11-year bull market. And then we see it plummeted and plunged. It is not the worst we've ever seen, but it was a very quick one. Now, the past 70 years, the average bear market is 14 months, and there's a loss of 33%. In the up markets, we see a different contrast. The bull market averages 72 months and a return of 279. What does this tell us? We have to be in the equity markets in order to survive the bear markets. The bull wins all the time, always has historically. Market volatility, of course, has reemerged. We see that the number of trading days when there's a 2.5% move has increased significantly in 2020. That includes the three indexes that are tracked, the S&P, the NASDAQ, and the Dow. So these numbers are showing how much volatility there is. But let's look at it a little bit differently. Rather than volatility, let's look at it as opportunity. So let's talk about that. Because of COVID, Congress waived the required minimum distributions for 2020. That's on all accounts. That's IRAs, 401ks, beneficiary IRAs, and all the other ERISA plans. So you have until August 31st, 2020 to return RMDs taken in 2020. So if you took an RMD, changed your mind, you can send it back in. Just call me if you have a question on that or you would like to do that. Second thing, rebalance your portfolio. Put it to where it should be. Now's a good time to rebalance. How much bond do you want? How much stock do you want? And that's what we can adjust for. Then the other thing is the possible Roth conversions, a little goldfish jumping out of its traditional plans into the Roth. It might be a good time if your accounts are down, because then there's less tax on moving them. So we need to look at that and see if that's a good idea. Review your risk tolerance. Is your risk tolerance really as high as you believe it is, or is it lower? Or is your risk tolerance too low for the time we're in? Remember, the horizon matters. When do I need my money? So if you note on the right, the horizon 1 is now, horizon 2 is near future, horizon 3 is way out there. Your accounts can also be strategied with that timeline in mind. Look at what can be done and determine your strategy. Benjamin Graham is a famous analyst on investing, and he says we should act as an investor, not as a speculator. An investor is one who looks at investment long term. Speculators looking for short-term profits, and he doesn't mind taking that market risk. But most of us are investors. We're going with the long-term approach, and actually that's a better situation. You're more successful if you're a long-term investor. We don't know what the exact market movements will be. However, we can prepare. So here's what we need to do. Instead of being afraid, throw fear out and be prepared. Is it going to be okay? Yes. Is it going to be more of a problem? Is it going to be something we can hold and wait? We just have to be prepared. So that means we have some time to talk and review. So the key takeaways from my presentation, 2020, the first 6 months has been a little bit rough. Volatility's come back. Remember, health is the main issue. So we look at your personal goals and we look at your concerns. What can you expect from us? Regular communication. We will do our client review programs. We are using Zoom if you want to do that. The discussions can be more frequent if necessary. We'll look at economic, tax, estate, and investment issues. So we really get an overview, and you'll receive our newsletters as well. So we want to thank you. We want to tell you how much we appreciate the opportunity of assisting you with your financial needs, remembering that your health and your well-being is our highest priority. You can help us help others. Send a friend our newsletter, give us their name, address, email, and telephone number, and we can sign them up to get our newsletter just as you do. Here's the disclosures, read them quickly, and we're very happy that you were able to join us today. So thank you for all you've done, and we look forward to chatting with you here in the near future.